Uncle Sam wants his cut of $1 trillion in corporate profits. But will he get it? Joining us for this week's Smith Business Close-Up is Mike Faulkender, an associate professor of finance at the Robert H. Smith School of Business. Professor, thank you for being with us.
Thank you for having me.
Let's explain this a little bit. The $1 trillion that's sitting in some sort of corporate piggy bank, how does this work?
Well, firms have their foreign operations, and if they keep the money in the foreign subsidiary, they can delay when they pay corporate income taxes to the United States government until they bring the money back to the United States. And by maintaining that money over there, they're able to use that money for other corporate purposes, but not yet pay the corporate income tax they would have owed had those operations taken place here in the United States. And if you look at the sum of the earnings over the last number of years that have not yet been brought back, it has added up to estimates indicate it's over $1 trillion.
So take a company like Apple Computer that makes money here, they make money all over the world. It's not in their interest to bring the money back. Is there any reason they would ever bring it back?
Well, there's some notion that at some point Apple's funds that they have invested in financial instruments would start to be larger than their overall operations. And so at some point, as an investor, you would be investing in Apple's stock portfolio rather than in Apple's operations in iPhones and iPads. So there is some notion that at some point investors are going to want their money back, and that would put pressure upon corporate executives to bring the money home. But this is largely what has led to a lot of the lobbying up on the Hill to try to provide an incentive for them to bring it back at a more favored tax rate.
And that would be sort of like the tax amnesty that the state comptrollers' offices around the country periodically run. How would that actually work?
The way that it worked in 2004 was that the Congress passed a piece of legislation called the American Jobs Creation Act, and within it was a provision to exempt 85% of the profits that they had made in the foreign subsidiary that they had deemed permanently repatriated. And so if you have a firm that, for instance, had $1 billion in their foreign subsidiary and they were to bring that $1 billion back, only 150 million of it would be subject to taxation. The other 850 million, the 85%, would have been exempt from taxation. And so they then pay the statutory rate on the 150 million that wasn't exempted. And when you do the math, that works out to about a 5.25% corporate income tax rate compared to the 35% that they would have paid in a normal year. And so following that act, we saw approximately $300 billion repatriated under the provisions of the AJCA. And there are those in Congress and in some of the presidential candidates from the most recent season that were advocating that we have another repatriation holiday.
Of course, the politics of that are a little bit sticky because nobody's giving similar holidays to individuals on their Form 1040. To talk a little about maybe the larger political situation with the corporate tax overall, is that rate in play in this election season?
Absolutely. We have the distinction in this country of having, as of April 1st of this year, the highest marginal corporate tax rate of the industrialized nations. Japan recently lowered their marginal corporate tax rate, and leaving the U.S. as now the highest in the industrialized world. And so there has been discussion about creating a corporate income tax structure that's more competitive with other global industrialized economies. And so the Romney campaign has argued that by broadening the base and reducing rates, they would be able to provide for a more globally competitive tax structure that would possibly incentivize firms to locate more of their operations here domestically.
All right. Mike Faulkender joining us from the Robert H. Smith School of Business. Thanks very much for your time.
Thanks for having me.